Hi, this is Nick Pollard. I'm an analyst at Cirrus Research, and I'm going to be going over our most recent signals report, hints of a broader market surface as the profit cycle begins to stabilize. And so signals is our monthly look at our key equity market indicators. Um, and really the highlight that I wanted to focus on is once again the CPQ, the Cirrus Polarization Quotient, um, which this month declined down to 44%, up from above 80% last month. So this is our measure of crowding. It looks at the premium of momentum stocks, hot stocks, versus the broader market. Um, and so, um, in some sense, this decline is a good sign in that it means that the premium of market leaders is now roughly in line with long-term averages. However, it's still notable that last month in that reading, that was actually the first time in a couple of years that our crowding indicator flared. So it still is worth looking at carefully. And then um, on the right, we have a pie chart that disaggregates the sectors within the momentum basket. You can see that technology is the first spot, which is, to no surprise. But in the second spot is industrials, a cyclical. And also 15% is categorized as the other. So there's actually a pretty wide representation of different sectors and industries in the momentum basket at this moment. From that perspective, there's something very healthy there. One of the ways to get out of the hot stock market, led by the Magnificent Seven or whatever you might want to term that selection of market caps leading the market, um, is a broader market in general. And what we saw last month was a sign that some of the market action was broadening the market. Um, Going forward, um, here is our equity allocation model. And it's important to note that we're still in favor of equities. The equity allocation of 57% is above the long-term average of 50%, and thus this indicator favors equities. And finally, I just wanted to go over the indicators in general, just because this month had a number of changes. As I went into some detail, market crowding is no longer an issue as measured by the CPQ, so that moved to neutral. Risk appetite remains in neutral territory. It ticked down slightly last month, and it's in roughly neutral territory. Um, Style, it recently moved to lean value from neutral. Um, this was really driven by the relative valuations between small cap growth and small cap value, which have returned to kind of the stretch state that we saw for parts of the pandemic. So something to look at there, particularly for small caps. And size wise, the model shifted from favoring large caps to a full overweight of large caps. A lot of the economic indicators that are a part of the um, size oscillator um, have been signaling a slower economy. So something like a inverted yield curve is a component of the size model. And as that's really a pretty remarkable yield curve inversion right now, that is considered to be bearish, as it's could be considered to be a signal that the real economy is slowing, the profit cycle is slowing, and thus you should look towards large caps over small caps. Um, and so, that as well as some of the other indicators in the size model are in favor of large caps. Um, and finally, we just discussed the asset allocation model, and that's still in favor of equities. Um, so if you want to see the full report, which goes into more detail in the as far as each individual indicator, check it out on the website. And if you have any questions, please reach out to Sacha or myself. Thank you.